This is it. The moment when the churning undercurrents of market chaos surface in a powerful display of manipulation and strategy. Picture this. It's February 3rd, and the normally bustling trading floors are a hive of unease. Reports buzz in the background like a chorus of anxious whispers. What unfolds today will become a landmark in financial history, pulling into the limelight the stark lines between fear-driven panic and calculated acquisition. Within mere hours, the market is shaken to its core. Retail traders, gripped by a dread that's as palpable as a dark cloud overcasting the horizon, frantically unload their holdings. Each hasty sale is a breadcrumb in a panic-fueled exodus as asset prices tumble into the abyss. Meanwhile, in the fortified stronghold of the financial elite, a different narrative is unfolding. Institutional investors, dubbed the smart money, have strategically positioned themselves like seasoned chess masters. While chaos reigns supreme outside their windows, inside there is clarity, precision, and an opportunity unlike any that has come before in 4 decades. This orchestrated dance between the frail and the fearless transcends the immediate spectacle. It's an exhibit of a sophisticated, age-old tactic playing out in real time. While the uninformed cry out over manipulated markets, the informed see through the haze, a whirlwind of volatility that is neither random nor merely an error. The February 3rd flash crash was not a fluke or a glitch in the matrix. Rather, it was a stark reminder of the enormous gravitational pull wielded by the few over the many. A colossal resetting of values was happening right under our noses. But amidst the chaos, who really spoke of the mechanics in play? Margin calls, forced liquidations, an engineered tremor that tested the market's very foundation, yet opened doors for those prepared. To the uninitiated, this shift might seem like a mere technicality, a trivial adjustment in the grand scheme of trading. But this was no ordinary move. It was a seismic shift that reverberated through the silver market, instantly transforming a somewhat stable environment into a cauldron of forced liquidations and panic-driven sell-offs. The margins acted as a hidden hand, pressing down heedlessly on those ill-prepared for such a sudden demand for capital. As panic spread, the price of silver was thrust downwards to an eye-popping low of $71.36. It was a breathtaking plummet, reminiscent of the market upheavals not seen since the distant echoes of March 1980. But just as quickly, the pendulum swung back. A remarkable ascent ensued, carrying prices up to $88.52, a swift rebound, encapsulating a staggering 20% rise within the confines of a mere trading session. This was not just another day at the market. It was the manifestation of a carefully orchestrated scenario where numbers dictated the moves with a precision akin to a maestro conducting a symphony. Institutions, the so-called smart money, stood ready, locked and loaded to capitalize on the unfurling panic. Their strategies honed to perfection. They swept in to reclaim assets discarded in the throes of retail despair. These institutional buyers had not been blindsided by fear. No, they were fueled by something far more potent, insight. They saw the temporary dip as an opportunity, not a threat, understanding with keen clarity that these fleeting prices would soon circle back to their inevitable highs, surpassing even the significant $100 threshold. In essence, the tale behind the flash crash numbers is not just about market volatility, but tells a deeper narrative woven into the very fabric of financial market dynamics. It's a dance of margins and liquidation, fear and greed, executed with surgical precision. A stark reminder etched into the psyche of market participants. In the realm of high finance, numbers hold sway, dictating fortunes and misfortunes alike. As we delve deeper into this unfolding saga, the underlying mechanisms of this financial tempest beckon. The story has barely begun. In the shadowy corridors of global trading, few dynamics prove as pivotal or as misunderstood as the enigmatic margin vacuum. This carefully engineered trap is not a happenstance glitch in the system, but a deliberate, calculated maneuver wielded by powerful institutions to shear benefits from chaos. Welcome to the mechanics of the margin vacuum, where the dismantling of retail dreams collides with the ascendance of institutional might. At its heart, the margin vacuum operates on a simple yet devastating premise: leverage. In layman's terms, traders often use borrowed capital to amplify their exposure to the market's vicissitudes, reaping potentially massive rewards with a fraction of their own capital invested. However, this borrowed capital comes with a condition: maintain the required margin or face liquidation of your positions. Essentially, these margins represent the thin line between maintaining a bullish stance on silver futures and the nightmare of involuntary sell-offs when the market turns. Now, enter the scene. towering figures like the CME Group, whose margin requirements swing the pendulum of market stability. When they chose to raise margins from approximately 9% to 15%, it wasn't merely fiddling with fiscal knobs. This move echoed like a bell tolling panic through the ranks of retail traders. Instantly, thousands faced margin calls, pressured to either pony up additional capital they likely didn't have or watch their positions liquidate at fire sale prices. The effects were immediate and catastrophic, for this was no ordinary trading day. As traders scrambled amidst the sudden liquidity crunch, the price of silver cascaded into freefall, triggering a mass exodus, yet simultaneously paving the way for those prepared to step into the void. And who stood poised at the brink of this orchestrated abyss? Institutional investors, the so-called smart money, armed with deep pockets and strategic patience. For these market leviathans, the uptick in margins signaled not a hindrance, but an opportunity, a green light to accumulate assets at a discount as retail investors were stripped of their holdings. This is the essence of the margin vacuum, a vortex designed to suck retail investors dry of their leveraged bets while incentivizing those who control the rules of the game to expand their empire. It's a high-stakes poker game where only a select few know all the cards on the table, maneuvering behind the scenes with precision and foresight. This margin vacuum, this silent predator, stands as a monument to the disparity between power and vulnerability within trading ecosystems. It's a testament to how leverage can be mercilessly twisted into a weapon against the unprepared, how institutional machinations transform sudden economic shocks into golden opportunities for asset accumulation amidst the rubble of retail hope. And so, the dance of high finance continues unabated. In this arena, filled with schemes as old as commerce itself, the margin vacuum is both a lesson and a warning. As it draws countless into its fearsome maw, one can only wonder, when the next adjustment looms, who will find themselves caught on the wrong side of the siphon, and will they even see it coming? The margin vacuum is but one chapter in an ever-unfolding epic of market dynamics. Keep vigilant, for the mechanisms of manipulation do not rest. They only evolve. As the story progresses, one must ask, what other hidden hands are out there, ready to twist the rules when least expected? The game is set, and the stakes have never been higher. The emotional roller coaster of the financial markets often transforms into a high-stakes drama, where rationality is a fleeting visitor. On February 3rd, the stage was set, and the actors were pushed into the spotlight, overwhelmed by an emotional cacophony orchestrated by unseen maestros. Here, between the lines of financial spreadsheets and market projections, lies the raw nerve of the narrative: manipulation driven by greed. As silver prices plunged precipitously, retail investors were not just responding to numbers. They were reacting to a visceral assault on their financial dreams. To the individual trader, this was more than a market adjustment. It felt like betrayal, a trapdoor opening beneath their feet. Panic gripped many as they watched years, perhaps decades, of cautious savings evaporate seemingly overnight. But for the institutional giants, this was not an obstacle. Rather, it was an opportunity gilded in the guise of catastrophe. What fuels such calculated exploitation? Greed, an insatiable thirst for wealth and control that surpasses mere financial gain. Institutional buyers saw beyond the immediate chaos, their gazes fixed on a horizon well beyond the turmoil. They anticipated a price resurgence above $100, a certainty buoyed by a blend of data analytics, insider insights, and, dare I say, orchestrated market pressure. But let's pause here and examine where this push and pull stems from. Anger and greed, two primal human emotions subtly twisted and applied like a craftsman using a tool. The traders, blindsided by margin calls, were driven by anger. Anger at the system, at themselves for being caught in it, and at their inability to influence the game. Meanwhile, for the orchestrators, greed justified the strategy, transforming a volatile market into a calculated opportunity. As retail traders were driven out by fear, the groundwork was being laid for a new narrative, a rise from the ashes orchestrated by those who bought low and waited patiently to sell high. Here lies the true nature of the market's emotional appeal. While the average trader is ensnared by immediate fears, losses, liquidations, and uncertainty, the institutional minds remain unclouded, lurking in the shadows, stepping in when others falter. They want you to focus on the chaos, the immediate thrill of gains or losses, because in doing so, you miss the larger game, the strategic resets happening just out of sight. This dance is not just about numbers, it's also about intention. Where others see chaos, these financial leviathans see order, predictable to them alone, crafted by their understanding of the cycle of fear and greed. As headlines screamed of chaos in the markets, the true narrative was one of exquisite control, where orchestration and opportunity met. If nothing changes, this schema will continue, unchallenged and unyielding, shaping markets and fortunes alike. Who among us will recognize the signs next time, when the cards are reshuffled, and perhaps prevent the manipulation from claiming another series of victims? The blueprint is there for those willing to see it. The shadows of the financial world often cloak the real dynamics behind the rapid shifts we witness, and February 3rd and 4th, 2026 were no exceptions. In these two pivotal days, the liquidity trap was set in motion against the volatile backdrop of the global silver market. But what really transpired during those chaotic hours, and why was it that a market reeling in pandemonium presented such opportune spoils for a select few? As we delve into the anatomy of this perfect storm, we must dissect the events of February 3rd and 4th, 2026. Unprecedented turbulence gripped the silver market. A concoction of factors, structural imbalances, heightened geopolitical tensions, and acute regulatory shifts converged to create a playground for those versed in market machinations. To understand this, one must look beyond the veneer of numbers scrolling across trading screens. It was a symphony of chaos orchestrated through deliberate maneuvers grasped only by those with a finger on the market's pulse. The CME Group's swift margin changes were a driving force. These adjustments, ostensibly market stabilizers, in reality acted like fuel to a fire, igniting forced liquidations that plunged unsuspecting traders into the deep. As trades unraveled, the price of silver tumbled to 71.36, a level that shook the foundations of confidence. Yet within hours, it rebounded sharply to 88.52s. For those caught unawares, this roller coaster was a death knell, a cataclysm born of calculated pressure. But for the sharp-eyed institutional investors, the rebounding prices were confirmation of their strategies. They had prepared for this moment, armed with algorithms and insights that defy the public's understanding. Let us not be fooled by the illusions carefully curated for the masses. Institutes weren't merely guessing. They were executing a game plan that transformed upheavals into dividends, aiming with surgical precision at a future where prices could soar above $100, unimpeded by immediate chaos. While retail traders discerned fragments of the picture, these orchestrators operated with clarity, exploiting every fissure they could pry open. The wider market narrative throughout these trading sessions revealed structural market signals and how they are interpreted differently depending on one's position in the financial strata. Retail traders, acting on emotion and fragmented information, often fall prey to short-term whims. Conversely, their replacements, institutional forces, remain vigilant to structural telltales and cyclical whispers which perpetually echo in financial halls. February 3rd, known infamously now as the Day of Reckoning, is a point of scrutiny and reflection, an epicenter of market symbiosis between panic and profit, destabilization and calculated accumulation. A vivid reminder that for every visible downturn lies an invisible hand, guiding the dust as it settles. As these events fade into history, they also reinforce the truth that every trader must remember. The tides of change may appear sudden, but they serve only as preludes to the next wave of strategic opportunity. Recognizing this allows us not only to understand past failures, but to anticipate future fortunes, revealing truths lurking within the market's designed chaos. On February 4th, as the dust began to settle from the tumultuous events of the previous day, the market entered an equally critical phase, one that would reveal the lines drawn among winners, losers, and the shadowy in-betweens. Silver's journey did not cease with the flash crash. Instead, the asset began a new chapter, characterized by a battle between the forces of panic-driven retail exits and the swift, methodical institutional consolidations. The stage was set for what market veterans might describe as a consolidation play, where the chaos of volatile trading began to stabilize into a new order. But make no mistake, this was not the mere calming of waters. This was a strategic alignment, a crucial juncture where the narratives of small-scale and large-scale collided, each playing their part in the grand orchestration of value rediscovery. As the market opened, the scars of February 3rd's drastic fall and rapid recovery remained fresh. Headlines flashed and investors found themselves at a crossroads. For many retail traders, fear lingered heavily, a visceral reminder of losses suffered, reinforced by the rapidity of price changes seen only a day earlier. But for well-prepared participants, this chaos was a smokescreen, a veil cloaking opportunity. Amidst this uncertainty, strategic investors found solace in charts, patterns, and the echo of historical data. Institutional players in particular saw beyond the immediate panic to identify critical support levels and resistance lines. The silver price attempted a steady march, testing the waters going into the morning hours. Each small peak and trough was analyzed with microscopic precision. Fibonacci retracements, moving averages, and momentum indicators danced across trading platforms. Attention turned to transactional volume and spreads, signs of market health and investor sentiment. Where liquidity flows emerged as one benchmark, the widening spreads served as a troubling reminder of residual skittishness. Nevertheless, seasoned players kept their focus trained on the horizon, wary of jumping to conclusions based on short-term volatility. As trades progressed, the return of confidence was palpable. Silver prices began to exhibit patterns of resilience, suggesting that the institutional presence was not merely passive but deeply entrenched. The narrative of the smart money moved from the abstract to the observable, as capital inflows supported price stabilization efforts. By midday, analysis pivoted towards consolidation figures, with technical indicators increasingly suggesting a preference for longer accumulation phases. Here, the roles reversed, institutions having absorbed the shock, fortified their positions, while retail participants engaged in cautious renewal, hesitant but hopeful. To understand this unfolding drama is to appreciate the market's undulating pulse, a rhythm that synchronizes with those savvy enough to sense the broader tune. February 4th session underscored a profound truth. Whisperings of reversal and resurgence were not merely possibilities, they were inevitabilities, contingencies crafted with precision and anticipated by those who dared to look further than immediate tremors. The consolidation phase of this market not only reconciled stray uncertainties, but also unfurled a wider tapestry. A reminder that within the labyrinth of financial turmoil, pathways of strategic significance emerge for those poised to seek them. The market's architecture, exposed in the daylight of analysis, illuminated the hidden choreography behind movements seen as erratic by the unsuspecting eye. In closing, the February 4th session did more than just authenticate a market's robustness. It captured the essence of resilience amidst dynamic pressure, painting a narrative of recovery and insight that flowed seamlessly from the previous day's pandemonium. Each tick, each spread, each volume was imprinted with the legacy of lessons learned, positioning the astute on the edge of understanding, always ready for the next echo of opportunity. Warsh, a name that stirred more than just portfolios when it was whispered in financial corridors. In February 2026, the nomination of Kevin Warsh as the new chair of the Federal Reserve poured fuel into an already blazing fire of speculation and market anxiety. This was not merely another change in leadership, it was a potential tectonic shift in monetary policy that could ripple across global markets. Here's the backdrop. Warsh, known for his hawkish stance, represented a pivot from the dovish policies that had been the hallmark of his predecessors. As traders quickly recalibrated their expectations, one truth became evident: markets were bracing for impact. The anticipation that Warsh might favor tighter monetary conditions sent jitters through trading floors. Investors, sensitive to any hint of rate hikes, began reassessing exposure across asset classes. Silver, a traditional safe haven, teetered under the pressure of potential policy shifts, reflecting broader uncertainties. Yet, it wasn't only the Fed's orchestration that demanded attention. Concurrently, shifting Treasury yields seemed to reinforce the narrative. As yields climbed, the dollar strengthened, a scenario that typically exerts downward pressure on commodities priced in the greenback, such as silver. The silver market, already volatile from systemic shocks, faced new headwinds. The combined force of higher yields and a resilient dollar index reminded market participants of their dual-edged sword, one that could cut both ways in times of economic churn. The interplay between anticipated Federal Reserve policies and actual market movements was not lost on institutional investors. They understood that the wisps of fear and hope, driven by Fed perceptions, offered windows of opportunity. As the market digested Warsh's potential impact, savvy players positioned themselves, anticipating both sell-offs and buybacks that could follow in the wake of policy announcements. This balancing act required not just foresight, but a deep understanding of how macroeconomic shifts translate into microeconomic strategies. Within this tumultuous landscape, we witnessed markets doing what they do best: adapting. Investors, with their eyes on the horizon, braced for adjustments not just in interest rates, but in how these macro pressures would play out on their bottom lines. The power struggles between rising rates and the flight to safety reveal the market's intricate dance, a choreography dictated by both economic theory and on-the-ground realities. The February upheaval, and with Warsh at its symbolic core, underscored the perpetual tension between policymakers and market drivers. It highlighted how quickly confidence could be tested, valuations questioned, and strategies redefined. The lesson for astute observers: in times of impending rate shifts and dollar dynamics, the silver lining is often found in strategic patience and an unwavering gaze towards the unfolding macro narrative. In summary, the nomination of Kevin Warsh encapsulated more than just a policy pivot. It signified a recalibration of market psyche. The echoes of this shift, amplified by treasury and currency fluctuations, continue to reverberate, teaching yet again that understanding global financial mechanics is the currency of true resilience.